So today is Tuesday, December 28th, and we are approaching the end of the year, and that means it is also the end of a quarter, and that is likely to unleash a lot of conversations around the JP Morgan collar trade, a trade that should take place on this Thursday or Friday. Now, this conversation is going to be in depth about what the trade setup is currently and some of the mechanics that we see around it. If you're unfamiliar with the collar strategy or what this JP Morgan hedge is, then we suggest that you check out this post here called the JP Morgan collar trade. We've entered the URL for this in the description for this video. Now, turning to the actual trade itself, at the moment, the market is around 4,800. And so what's going to happen is the current position, which is a 44.50 call that expires on December 31st, that is going to go away, and a new position is going to be added that is in March. And we want to touch on that option first as it sets up the explanation for what may happen on Friday. So on the screen here, we have two call options, and this is just going to give you a background on what we think takes place. So the current position here is a 44.50 call, and as you all know, the JP Morgan fund sells this call to fund a put spread. So the market makers, or dealers in this case, it's likely a bank, has a large long position of the December 44.50 calls. And as you know, the market, which is currently up around 4,800, so this is a deep in the money call option. So if the market is here, the delta, which is our y-axis, is around a 1. So that's 100 delta, which means that there's likely a lot of big short futures hedges on. So they will be likely short the ES futures against this position, and it's heavily hedged, such that there's no directional exposure for the dealers here. They're waiting for this thing to expire to roll off their books, and then they're going to have a large short position. So to do that, they're going to take this. And they don't need that 49.50 call. And now why thereabouts, of course, it depends on where the market. It depends on where the market is heading into Friday, but 49.50, give or take, maybe a couple handles. For purposes of our conversation here, we're just going to use this March 49.50. Now, what you can see is if the market's at 4,800. The delta of this new option is somewhere near a 35. Now, again, depending on which option it is, the strike selection, we could have a little bit of a higher or a lower delta. Plus, remember, there is a put spread that they trade as well, so that will change this delta. But again, for purposes of the conversation, this will make it kind of explicitly clear what we think the trade is going into Friday. So again, we have a fully hedged, deep in the money call option that is likely to hold a lot of short hedges for dealers, and then they're going to be rolling into a trade that has a much smaller delta, somewhere, let's just say near 30 for sake of expiration. So that means that there's 70 deltas of exposure, short exposure, that the dealers are likely to be holding that they don't need anymore, right? They don't need all of these short futures anymore. So they need to buy these futures back. So the key takeaway from this trade is that on Thursday and Friday, this is a large, in the billions of dollars likely, futures buyback for hedges. And this is a different trade than what took place in previous expirations, and let's touch quickly on why that is. So we look at this chart here. You can see that in June, the JP Morgan trade would have sold some out of the money calls. So with the market near, let's just say 4,300, they would have sold some out of the money calls, let's say in the 44.50 area, to buy a put spread down below. Now, when we approach September, which is when these June contracts would expire, you can see that the market is around 43.30. So any calls sold above 4,400 would be expiring worthless. So that meant, remember, that these are hedges, the dealers are long these calls. These calls expire worthless, which means there is no hedge in place at the end of September. So at the end of September comes, and we know that JP Morgan decides, okay, we're going to sell the 44.50 calls, which means that the market makers are going to be long those calls. And at that point, they don't have any hedges on. They don't have any existing hedges on. And so they'll sell some futures to hedge themselves out. So let's show you what happens in that instance. If you look at the trade that actually took place, we posted about this on Twitter. I'm going to zoom in on this chart. This is a pretty interesting setup here. Now, remember what we said, that the dealers came in with a September position that was expiring worthless, but they needed to add the December position on. So what happens? Well, initially, the trade sets up and everyone believes that it is this trade here. It's selling the 45.05 calls to buy this put spread, the 41.35, 34.80 put spread. Now, what you may notice is that trade takes place here, and then the market has a pretty big sell-off throughout the day. And this sell-off, I think, caught some people off guard. If you're one of our subscribers, and incidentally, if you sign up for a free trial, you can actually go back to our notes from this day, from the 30th, and we talk about this kind of in real time in detail. It's pretty interesting. But our point here is that everyone said, okay, look, it's 10 in the morning, and this big trade went up. The JP Morgan hedge is on. And what turns out happening is the market declines sharply, and then this other big trade goes up. And if you look at open interest, you'll see that these are the calls that are actually in place. So what happened was the initial trade went up, and then at the end of the day, around 3 o'clock, this new trade went up. And you'll notice that these strikes are all basically equidistant, 50 strikes lower. So what happened there? Well, if you are the bank that is dealing with JP Morgan on this trade, you need to hedge yourself. JP Morgan understands that. And so they put this trade on, they hedge it out. Now, as the market drops, that likely led to losses for the dealers here, right? Because they're pushing the market down. They're long this call, and their futures are hedging, their futures hedging is driving the market lower. So what do they do as an adjustment? Well, they reprint now that the hedge is on. They roll these strikes to a lower level, and that compensates them, we believe, for the fact that the market dropped as they got their hedge on. So here they're fully hedged, right? And so that is the mechanics of what took place on that specific day. Now, what is kind of interesting about this trade is that we have something of almost the opposite situation, right? Now, that was the case of not having any hedges on, right, and adding a new trade where they needed to short deltas to hedge themselves. What's interesting about today is obviously the market is up at 4,800, so we're going to run into a situation where the market maker has too many short deltas on. So they're going to add a new trade, but they're going to have some short deltas that they need to cover. Now, exactly how they cover that and the mechanics of that are not totally clear. I think they'll do some things, obviously, to not try to move the market that much. So what that means for Friday is that, as we mentioned before, JP Morgan is going to be selling some calls that are somewhere up in here, and they're going to be buying a put spread that is somewhere down around here, and they'll have too many deltas, right? They're going to be short deltas as a result of the hedge that's expiring, so they will have deltas that they need to buy back in and around Thursday and Friday, and that should keep a little bit of a bid into the market as they adjust those hedges. Now, just to get a handle on some of the notional exposures we're talking about, if you look at the size of the in-the-money contract that expires on the 31st, that's December, we have 45,000 in-the-money contracts. Those are the 4450s. That's a delta notional exposure of roughly $21 billion. And if you look at the March contract, let's say that they roll just to the same size. It's likely not to be 45,000, but just for the sake of argument, 45,000 contracts with a delta closer to 30 gives us about $9 billion. So you can see that the net exposure here is around $11 billion. Now, there are a lot of factors involved in this, including, which put spread did they put on, which strikes do they choose, what contract size, etc. But you can see that even if we adjust this up or down to several $billion one way or the other, it is a large trade, and this, we believe, has to be bought. We think the dealers are too short by the value of roughly, let's say, $10 billion, give or take a few billion, and so we think that that is a tailwind of some type for the markets into the Friday expiration. And then after this large expiration, where there is a lot of gamma expiring unrelated to JP Morgan collar trade, there's a chance that volatility picks up next week, the first week of January, as the gamma expires and this JP Morgan collar trade is settled out. Now, if you have any questions on this, please put them in the comment section below. We'd be happy to help. You can also send us an email at info@spotgamma.com. Thanks.